Good morning, good afternoon, good evening, folks. Wow, look at that. I brought back the old introduction. We are going to talk about RedFin's CEO. We're going to talk about pending home sales, see what the chief economist at Wells Fargo has to say. And then finally, this is the daily financial news for Thursday, September 28th. Wow, the month is almost over. Let's just jump right into it. Jamie Dimon proposed that 7% Fed funds rate is not out of the question. In fact, if you read his article, he's talking about it possibly being as high as 40%. So a 7% Fed funds rate, today it's about 5.5, 5.375 exact. I want to paint a vision of how that might happen. Because I think a lot of us look at a 7% funds rate and go, oh my God, it's over, all of that. And don't get me wrong, there will be plenty of pain. But let's at least have an educated conversation on how we get to a federal funds rate of 7%. Because I think there are signposts that you and I could watch to see if Jamie Dimon is right and we have 7% funds rate. So I think there are a couple of things that you and I could watch on a weekly or perhaps monthly basis. And the first one we have to watch is inflation. I suspect we would have to have meaningful inflation reignited. And it is certainly possible. We have seen oil shoot to over $90 a barrel. I think I checked this morning, it is 93. I saw an article yesterday talking about our strategic petroleum reserve hitting emergency low levels. So, could the U.S. government suddenly become a competitor to buying oil as it refills the SPR? Absolutely, at least in the short term. We would have to have shelter likely complete its rollover and yet reignite again. I agree, it's possible. High rates, nobody can buy, more renters. Possible. We would also likely have to have above trend growth. Unemployment, the job market remain strong. I think it is a tall order to kind of play out the next 6 to 9 months to get to 7% funds rate. Because again, the Fed won't just yank us to 7%. Frankly, I think if you listen to them, they're kind of 50-50 on whether or not they want to hike again because of lag effects. But if we postulate, if we say, how do we get to 7% Fed funds rate? I think those are the things over the next 6 to 9 months that get us there. So I think there are plenty of things to watch. A couple of things about Jamie Dimon's speech that I think go unnoticed because of the shocking 7% Fed funds rate call. One, he is encouraging his clients to hunker down. Batten down the hatches. You have heard Jamie Dimon over the last 12 months talk about a hurricane offshore. You've heard him talk about, all of these headwinds coming at the U.S. economy and the U.S. consumer. He is telling folks to batten down. And if you've been following this channel, you know that I agree with that. It's about being prepared. It's about, frankly, making sure you're able to take advantage of the opportunities that are coming. This is not 2020 and 2021 when risk was zero and money was free. We need to realize that there are lots of financial engineers who are going to get hurt, and hurt in a massive way. But that will create opportunity. It happens every time. But you have to be in a position to take advantage. So I agree. Get ready. See what's going on. Don't do anything silly. Next, I agree with this point a lot. The next 200 basis points, going from 5 to 7% Fed funds, would be more painful, and I would argue much, much more painful than going from 3 to 5%. This last 200, if we have to go that direction, would break stuff. We're talking regional banks. We're talking pensions. There's a lot of assets that are on balance sheets across the world that would be significantly devalued if we saw Fed funds go to 7. Because what does that mean? If Fed funds go to 7, what is the 10-year like? 6%? 6.25%? Mortgage rates 9.5%? 10%? We would feel that. So again, I think 7% gets a lot of headlines, but realize that you and I could watch stuff over the next 6 months to see if it's possible. And I suspect the Q4 economic numbers are about to get ugly. We actually have one of the ugly numbers we'll talk about today. But let's keep going. How about Wells Fargo? Wells Fargo, frankly, is taking the other side of Jamie Dimon. Wells Fargo expects the Fed to cut dramatically in 2024. Wells Fargo is of the belief the Fed has gone too far, too fast to the U.S. economy. And it's, I think we're about to start to see some of that. Again, if you go back and watch the videos, I was calling for a Fed funds rates of 5% even. I thought that last quarter point raise was too much. We'll see. I don't think they're going this year. I think they're going to try to hold out for next year, but it's going to be really dicey because, again, I think the economic numbers are about to get ugly, and we'll talk about one of them in a minute. How about RedFin CEO, good old Glenn? Good old Glenn is out talking about the housing market has hit rock bottom, to which I would tell Glenn, sorry, buddy. It's going lower. Transactions are going lower. Glenn is talking about 4 million transactions for existing home sales being the bottom, where we peaked at 6.6 in 2020 or 2021. I think 21. Glenn, we're going lower. We are breaking the 4 million mark this month. We're going to see that number next month. Sales slump won't, and the sales slump will last a long time. I agree. You have heard me talk about the transaction volume in the real estate market being down for 5 to 10 years. I do believe that 4 million is the kind of natural, market. Like it never goes to zero, but we're going below 4 million in September, October, and maybe even November. So again, I believe the economic numbers are about to get bad. How about pending home sales? This is the first economic number that I believe has really felt the effects of the Fed's last discussion. Folks, pending home sales last month were up 0.5%. They were expected to be down 1%. They're down 7.1%. Remember also last month, I think it was Lance Lambert told us that cancellations were 15% because these are pending. These are pending home sales. We are going to see cancellations. Will they be as high as last month? Who knows? There will be some. We know that. But yes, folks, pending home sales down 7.1%. We are repeating last year. If you are a flipper, a wholesaler, or whatever it is, realize what's going on. Remember, you are closing deals now that you lost money on in January and February. Don't do that again. Learn your lesson. Buy better. Don't buy. Sometimes not buying is the right thing to do. So again, pending home sales down 7.1%. Oh, hey man, thank you for the super chat. You canceled a contract. Good on you. Again, The market's different, folks. I keep telling you, right? Only great deals, only great deals. I'm very conservative. I'm not telling you to buy. I'm begging you to do the work. Student loans, finally got a number on that. It is expected that student loans will suck $8 billion out of discretionary spending. That's going to be a huge headwind on top of strikes, on top of government shutdowns, on top. It is expected that consumer spending goes negative in Q1. Again, folks, the economic picture is getting less bright. But again, remember, where there is great pain, there is great opportunity. Please see all of this as opportunity. If you do the work, if you understand average, if you are prepared, you can make hay in a recession or a bear market or whatever you want to call this thing we have to go through. Government shutdown. Goldman Sachs says the government shutdown is 90% chance. They think it will last 2 to 3 weeks. I think a government shutdown is 100% and will go more than 30 days. So we shall see. And there's a chance that this is the longest government shutdown on record, which I believe the current record is 55 days. Double nickel. Small bank. I want to let you know about a conversation I had with a small bank. It was about a month ago. Small bank where I have a loan and they have my financial statement. I have no money. I just have a loan there. They called me up and said, Michael, we would like to extend our relationship. We'd like to grow our relationship. We would like to offer you some lower rate mortgages if you have some other properties you would like to refi with us. We will give you below market rates. I'm like, okay, what's the catch? He goes, we are only lending to clients that deposit 6 figures with our bank. Folks, this is a sign. This is a sign that there are a lot of small and regional banks struggling to keep deposits, right? This is a signal that there's a lot going on that you and I might not see. I thought that was a very interesting conversation, and we are having more of them, so I will keep you up to date. And then finally, folks, remember, one of the things we do here at One Rental at a Time is we have an amazing course called How to Get Started One Rental at a Time. It is a measly $3.99. It is changing lives around the country and even some overseas because it tells you how to become a great real estate investor. It tells you it takes work. It tells you you have to have a buy box. You have to look at it. You have to learn. You have to figure out average. It tells you that it takes 90 days. It gets you in an amazing private Facebook group with other folks doing the work, plus all the bonus sections and all of those other things. If you are going to get ready to do the work in Q4 so that you're ready to make moves in 2024, go get the course, How to Get Started One Rental at a Time. Ask to join the Facebook group. You won't regret it. All right, folks, take care. Wow, that pending home sales number down 7.1%. It's going to get interesting. Take care. Bye-bye.